All right, grab your favorite mug. It's time for Coffee with Your Retirement Coach. Welcome back to Coffee with Your Retirement Coach. For those of you that have completed your to-do list from episode 1 of year-end tax planning, we got more stuff you got to do. Sorry. Listen, we got to get you optimized. Nick, being serious, some things for people that are earning income, people that have assets that are appreciating. We've got some things we want them to work on
now.
Yeah.
Like yesterday.
Yesterday. If it's convenient, if you could schedule that in for yesterday.
Yeah, well, and Aaron, I love what you said in the last episode. It's one of my favorite things I think I've heard around our office. Investing is a matter of opinion.
It's true.
Taxes are a matter of
fact.
Yeah.
It's a matter of fact.
So, we're talking about real dollars saved in taxes.
Yep.
And that's the thing that I hope people take away is, what can you do to keep more money in your pocket?
Listen, that's right. It's not about what you have. It's what you get to keep. And behind the clipboard today, talking to us about what we get to keep, how we could keep maybe a little more of it.
Yeah.
Be mindful of higher tax rates in the future. Nick Yeomans.
Yeah. Hey, buddy.
I'm your host, Aaron. Today on Coffee with Your Retirement Coach, that's what it comes down to, is we want to make sure that we're as tax efficient as possible. And so it's the areas of place that we need to be looking back. And for some, it's a fresh brush up. And for some, it's there's been some changes. And it might be law, it might be habit. But Nick, let's start off with those that are earning income.
Yeah. Well, Aaron, I tell you, if you are a wage earner this year, so if you are W-2 income, 1099 income, so if we're not talking to the retiree who's living on pension, retirement account distributions, and Social Security, okay? So you're a wage earner or 1099 income this year.
Right.
You've got to know the numbers again.
Yeah.
Okay. This year, 2024, there have been several increases into the limits that you can make contributions towards various types of retirement accounts. So in our audience today, if you have access to a 401k, a 403b, a 457 plan, a simple IRA, a SEP IRA, if you have access to one of these incredible retirement accounts, you want to make sure you are maximizing the benefit. And there's two things to consider, Aaron.
Yeah.
Number one, are you contributing at least enough to get your employer's match?
That's huge. If you've got the benefit of an employer match and you are not figuring out a way to make that happen, what are you doing?
Yeah. That's called free money.
Yes.
And that's 100% rate of return on your money.
Yes.
Okay. So you definitely want to take advantage of any employer match. The second thing you should consider is, are you maximizing your contributions?
Yes.
So you can have a Roth 401k, again, lots of different types of retirement accounts, but because the limits continue to increase, my encouragement to you in our audience today is speak to your HR, speak to your benefits manager, speak to your office manager, whoever is helping facilitate that retirement plan for your company.
Yeah.
Talk to them and make sure you're on track to maximize the contributions to those retirement accounts.
So step one, I got to make sure that if there's a match, I'm not leaving any money on the table. Am I at least matching? But then behind that, what are the contribution limits? How can I max that out? But then, Nick, am I eligible for a catch-up?
Well, that's a great question, Aaron. So here's an example. I mean, if you are over 50 or older years old.
It's easy for you to say.
Yeah, Aaron, I don't talk so good sometimes, but I can do math. All right. So as an example, if you are 50 and older, you could qualify for a catch-up. And so for what does that mean if you have, as an example, a 401k or a 403b? Well, that's an additional $7,500 that you could contribute towards that work plan. So that could bring your total to $30,500 this year that you could put away towards retirement. And that's before taxes, or if you have a Roth option, after tax, but tax-free forever. Now, the other one is the IRA. In the IRA contribution, if you are 50 and older, that's $1,000 increase over the maximum. So that's a total of $1,000 that you could put towards a traditional IRA or a Roth IRA.
Oh, man. Now, here's what's important, and this is why it's one of the things that we're leading off this episode with. This contribution type that we're talking about right now must be made in 2024.
Right. Well, with the exception, Aaron, of those IRA contributions, if it's not an employer plan and it's not like an individual 401k or a SEP IRA, then you have until tax filing time to make those contributions. But here's one other little hiccup. Aaron, just last week. Yeah.
Let's circle back around on that.
All right, go ahead.
I feel like we put a lot of commingled on there. Contributions to your work plan, end of the year. Contributions to a traditional IRA, to a Roth, if you are eligible, because there are limits. And this is why it's so important all the time. We tell you, seek wise counsel, raise your gaze on these things. Those types of contributions can be made up until the deadline of next year.
Correct. Thank you.
For 2024.
Oh, perfect. Yeah. And, you actually hit exactly where I was going. Knowing your numbers, we always come back to that.
Well, Nick, it's crucial. We cannot be shooting into the dark on this. We're never going to get where we need to be guessing without being able to add the education. We want to make an educated guess.
Yeah. Well, one of those things that I've seen people kind of make a mistake on, including last week, I reviewed the last 2 or 3 years. Actually, it was 3 years of tax returns for this gentleman in a consultation. Mm-hmm. And he had been making fairly large Roth contributions, but based on his income, he's ineligible.
Yeah.
For years, but his CPA has been helping. And I'm not picking on CPAs or anybody. I'm just making a point, like, you need to know the rules, you need to know the numbers, right. And what's the carpenter's rule?
That's right, buddy. You got to measure twice. We're going to cut once.
That's right.
Yeah,
that's right. So anyway, make sure that you are seeking wise counsel on this.
Now, listen, here's what's also great. If you're excited, but you can't contribute, or if you can contribute, but you want more in that tax-free bucket, it's another C word, Nick.
Yeah, it's called conversion.
Conversion.
Another great thing, again, this has to be done by December 31st of this year to be able to do this for 2024. So you cannot wait until tax filing date. However, you have up until the end of year to do a Roth conversion. This is the process of taking money out of a before tax plan, or if you're trying to do a backdoor Roth IRA, out of a after tax traditional IRA and converting it to a Roth IRA.
Yeah.
So that's a powerful strategy. You should, again, talk to your tax advisor or your financial professional on this so that you know your numbers. But, man, it's such a huge opportunity. I'm a huge fan of Roth. I love tax-free.
Absolutely.
But that does have to take place by the end of year.
And it is one of those things we wanted you to have it on your list, because if you don't already have a Roth account open, you've got to open one. You cannot do this strictly having a traditional IRA account open. So depending on where you're at the time of year, opening an account can be a simple and a quick process, and other times it might be more challenging. So when you're talking about the fact that you want to run this by your CPA, you want to have the account ready to catch it, there's a few things. You probably don't want to start this December 26th.
Facts. The thing is, people at Schwab, Fidelity, Vanguard, all these wonderful companies, they happen to take vacation.
They do. There's a lot of us that have to go see family at the holidays. We've got vacation time
that's
got to be taken.
Fun fact.
Yes.
What is the longest hold time you've ever experienced with one of those companies?
Oh, my gosh. I mean, I could have watched one of the Lord of the Rings movies. Yeah, no.
I was going to say, like, my maximum, and it had to do with year-end tax issue with, and also a state settlement because the client's spouse had just passed away.
Yeah.
2 hours, and it was like 27 minutes. I was on hold.
Yeah. No, it can happen. It can happen.
Yeah.
And it's one of those things you don't want to come to that aha moment. I need to do this. It's affordable. It's a no-brainer. And it's just the logistics of making it happen at a time of year where you probably have other things going on, causing it not to happen. What a pain. What a pain. Yeah. What a frustration.
Yeah. So important, if you are considering Roth conversion, time's of the essence.
Yeah. Nick, we've had an incredible year in the market.
True.
I have had a constant conversation with clients and said, look, in some ways, I know it doesn't make sense. We're gonna get all the goodie out of it, as we would say.
Yeah.
That's the professional way to phrase that.
That's the professional phraseology.
We're gonna get all the goodie out of
yeah.
it, but there's parts of it that don't. I mean, we would have expected more volatility in a summer leading up to a presidential election.
Oh yeah. Well, I'm still not sure that the coast is clear just yet. I think that there is certainly a lot of evidence that could point towards more volatility, but this year has been it's just been a remarkable market, and it's been one of those years you're really glad you weren't hiding under a rock.
Yeah, no, it's true. It's true. And for those that stayed invested, stuck to the plan following 2022, some of their non-qualified accounts have assets with significant gains and low basis.
Yeah. So this is an area where you want to look for opportunity, but you also want to look out for some danger. So here's an example. If you have significant gains in your portfolio, and let's say, all hell's breaking loose, and, all of a sudden there's massive laws around AI and a company like NVIDIA gets hurt, or, there's something that, there's a new FDA director who comes out and they say they don't like some of the ingredients in certain soft drinks, or something happens that's major in a company that you've had like tremendous buildup in terms of gains. Well, if you're in a position where you're forced to sell, that could really, really hurt.
Mm-hmm.
But there is a strategy out there that you should absolutely consider by the end of the year if this is you, and it's called gain loss harvesting. And that's the action of looking for losses in your portfolio and gains in your portfolio and selling them so that you're washing out the gains and the losses. So long-term capital gains can be washed out by long-term capital losses. Now, I'm going to tell you one trick here, Aaron, and this is like this little golden nugget I'm going to give you because this happens time and time and time and time and time again, where we're reviewing someone's tax return and we discover they have significant amounts of tax losses that they're carrying forward.
Yeah.
Because if you do not wash out your gains with losses, I think you can only write off or deduct $3,000 off of your losses per year. So if you've got $100,000 of losses, you used up $3,000, but you didn't take any gains, then you've got $97,000 that rolls over into next year.
Right.
So we just had a client who had $90,000 of long-term capital gains, long-term capital losses that we found in their tax return, and they didn't know it.
Right. Nick, before you jump into that,
Yeah.
we always talk about knowing your numbers. Let's talk about the stakes.
Yeah.
We talked about brackets previously when it comes to income tax. When we're talking about numbers like 90,000, 100,000, talk about knowing your numbers.
Yeah. So, let's just say that we did not discover this 90,000 in this tax return.
Right.
Okay. And this gentleman just wanted to sell a piece of the portfolio, and he had $90,000 of gains, just making it up for a second. Okay.
Yeah.
Well, let's say he's in the 15% bracket. Okay. Well, that's about a $13,000, give or take, long-term capital gains tax, not including any state cap gains taxes or income taxes if you have those in your state.
Right.
So, let's call it 15,000 just for even. So if you didn't know that you had those losses and you went and you took those gains, you're going to pay those gains.
Yeah.
Right. Unless your CPA or tax professional is taking a look and they're going to wash them for you.
Yeah.
Then, you might end up with a cap gains bill that you didn't have to have.
And when we're talking about 15, sometimes 20 cents on the dollar, this is worth paying attention to.
Oh, yeah, 100%. And so our recommendation for most people is you should be, if you're working with an advisor or a financial planner, some kind of financial guru, they should be looking to help you offset your tax bill throughout the year. This isn't kind of one of those things that you do every now and then.
Yeah.
It's called a plan, and you execute a plan.
Yeah.
Right?
Yeah.
So here we are approaching year end. One of the things, if you've got non-qualified dollars that are not in traditional retirement accounts, you should be working with your financial guru to determine, do you have financial or do you have long-term gains? Do you have long-term losses? Can you wash those out in a place where it would make sense?
Well, and Nick, in preparation for this, I feel like one of the biggest trip ups before we ever get to that point is knowing our basis.
Yeah.
Well,
Aaron, I'm going to put you on the spot. Talk to me about basis, because I know you just went through something. Like, we were working on a case today.
Nick, it is wild to me how often we have a client come in and we talk about the fact that there is no basis on an asset, that we've got that big zero.
What is basis?
We want to show how much we paid for something. Okay. So let's just say I bought Home Depot stock, for instance, and I paid $100 for that Home Depot stock. And today that Home Depot stock's worth $300. Well, my favorite uncle, Uncle Sam, wants gains tax on the $200 in profit that I made while I owned it. And let's just say that I held it for more than a year, then I'm talking about long-term capital gains. Well, here's the thing. If I come over and on my statement, I paid $100 for that Home Depot stock, but there's a zero on my statement. If I sell it, is Uncle Sam going to be really understanding and be like, well, I mean, obviously he didn't pay nothing for it, or am I going to be on the line for 15%, 20% on $300,000 or $300?
Yeah, so you're going to pay that tax on that $300.
Yeah.
That's so ugly, and that is such a common mistake that we find. So if you're in our audience today and you do have non-retirement account dollars in a brokerage account, a trust account, you want to make sure when you're looking at that statement that there is basis recorded on it, because, Aaron, we've had clients come in and they had someone managing their portfolios, making all kinds of trades with zero basis, which means every single time there was a trade and there was a gain, the entire amount was a gain.
Yeah.
Right? The entire sell, the entire transaction. For how many years were they overpaying their taxes because no one was paying attention that there was no cost basis recorded?
And not equating the two. Well, fantastic that we had fantastic asset management, but if the taxes are running buck wild because nobody is, we're sleeping on the fact that we have undocumented basis. I mean, what a tremendous loss that didn't have to happen.
That's right. So know your numbers. And make sure that basis is recorded.
No, it's so true. Now, as we are doing realizing of gains, we're paying the taxes, we have to be really careful about the wash rule, Nick. So let's say you've taken that step. I know how much I paid for things. I'm aware of when it might be good to get in, to get out, or to work with a professional, like donating in kind to a donor advised fund. But while you're doing these things, you're going to have the opportunity to buy new things, and we want to do it the right way so we don't raise a flag and make an issue.
That's right. So, a common mistake. So with the wash rule, if let's say I own the S&P 500 index and it was just a S&P 500 ETF issued by iShares, okay, or it doesn't matter who it is. This is not an endorsement for any fund company or any share class or anything like that, okay?
Educational purposes.
Just educational purposes only, okay? Mm-hmm. But let's just say I wanted to take a loss and sell that S&P 500 fund, okay, or ETF. And then I immediately turn around and I buy Vanguard's, S&P 500 ETF, okay? Is it the same company? No. However, they are both the S&P 500 ETF, and that is very frowned upon with the IRS, and that means you would have violated the wash sale rule. And what the wash sale rule is, you can't buy the same asset or a very, very similar asset within 30 days of that sell. So I can't sell and then go buy an S&P 500. Now, could I go buy, a different index fund? Like could I buy a Dow? Could I buy NASDAQ? Could I buy, probably. Could I buy a real estate ETF? Could I go buy a small cap ETF? Yes, absolutely. Mm-hmm. So it's not that you can't turn around and reinvest. It just can't be reinvested in the same or similar.
Yeah. For how long, Nick?
30 days.
30 days. So either wait a month or find something that's dissimilar enough that you can invest in immediately and not cause an issue.
Exactly.
No, I love that.
I did have somebody ask me, could I sell my Coke stock and turn around and buy Pepsi?
Yes.
Well,
nope.
Hold on. He started laughing and said, I'd never do that. I retired from Coke.
Even if it's an option according to the IRS, it's not an option with my soul.
No. Well, I tell you what, Coca-Cola people are about the most loyal people to a brand that you've ever met.
They are.
Love our Coke folks.
Love that. Nick, kind of wrapping this up, anything else that you feel like is notable for us to make sure that in this segment of the tax planning for year end?
Yeah, there is one more thing that, I know our audience members that are tuning in from some of our higher taxed states, they've been wondering this. I know that, many of them have been following the tax plans of both Kamala Harris and Donald Trump and trying to find out where they're going to land. If you're in a higher tax state, New York, New Jersey, California, there's a lot of states out there. One of the things that's really messed you up about the Tax Cuts and Jobs Act is this thing called the SALT cap.
Oh.
Right? And the SALT cap stands for state and local taxes. Even though there's so many good things about the Tax Cuts and Jobs Act, one thing that did absolutely hurt a lot of people is the inability to deduct all of your state and local taxes, right? So you are capped at $10,000 of state. So if you have property taxes, you have state taxes, you're at $25,000, $30,000 in some of these states. You are limited or capped at $10,000. That's still in effect right now today. I know a lot of people were kind of hoping that would be changed, adjusted. It's not. So that $10,000 SALT cap is still here.
Awesome. Nick, that's so good to know, and I thank you for sharing it. It is a reality that we can't have any control over the tax laws, but we can be knowledgeable about them and know how to adapt.
That's right.
And for those of you who have adapted more generously, email us. We love hearing those stories. We believe that you become more of what you are. If you are generously minded, if you have compassion for your neighbor, we know that when you have more opportunity, we see more of those things. So continue to email us at connect@yourretirementcoach.com. We want to hear those stories. We want to hear what came out of this. Over our last couple episodes that have been about year-end planning, there's more. So for those of you that have listed and been proactive, the list is going to grow. But right now, I want to thank you for listing. I want to thank you for listening. And I want to thank you for remaining coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeomans Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass.